Hey, good afternoon. Welcome to today's event. This is a top 10 stock pick sneak preview. Monday, May 13th. You got John Hopkins here. Tom Bowley going to jump in just a minute. Hey, if you happen to be new to Earnings Beast, want to welcome you. Thank you for taking the time to come in. Of course, we thank all of our wonderful subscribers. Many of you have been with us for a long time. Today's event will be recorded. If for some reason you're unable to stick around, no problem at all. You'll be able to listen at your leisure. As a reminder, tomorrow night, great timing, by the way, with the market, looking pretty strong here. Tomorrow's our Max Pain, Options Max Pain event. One of my favorite events. That'll be at 5 o'clock tomorrow night. And that's when Tom will take a look at options, some of the, the ETFs, the Qs, the spiders, and maybe a few stocks as well. Of course, we sent out to everybody over the weekend. We sent you a list of Max Pain potential candidates. So we'll be discussing that tomorrow. But tonight is something that I'm also looking forward to, that I want to make sure Mr. Bowley's in the house. How's it going, Tom?
Good afternoon. Good afternoon, everybody. I'm right here. I'm right in the house.
He's in the house. How was your weekend?
Pretty busy because still trying to catch up from my trip. So a lot of the chart lists pretty much got updated, except we had 1 week left where I didn't get to on the raised guidance, but that should all be updated this week. So we should be back on the grid and running. But overall, yeah, not a bad weekend. I mean, happy Mother's Day to any mothers out there.
Yeah.
Had a good Mother's Day weekend here, and yeah, overall not bad. How about you?
Good. It seems like the rule of thumb is like for each day you're out, it's 2 to 3 multiple, for making up. So
Yeah.
if you're gone for 5 days, it could be 10 days before you catch up to everything. But it seems to be. But
Yeah,
you
it's
know,
particularly so during earnings season. I mean, I
yeah,
know when I take a few days off during earnings season, it's going to be a
you're gonna
killer
pay
trying to
for it.
get caught up.
Yeah. All right, let me go ahead and let you get started here because I know you got a lot to cover.
Yeah, I'm hoping not to keep everyone too long here, maybe 45 minutes or so. That's my goal. We'll see if we can stick to that. But really, I just want to go through and talk through our portfolio performance, really since inception, but in more particular, I guess, this last quarter. Talk about some of what went right, some of what went wrong, and kind of go through all of that with you. And then we'll turn our attention and talk a little bit about some of the things that we really need to consider over the next few months, because our draft is coming up. The actual event will be on Thursday after the close this week. That's where we will announce the stocks that will be included in each of our portfolios. And so we want to go through and talk about some of the themes in trying to determine which stocks or which areas of the market may benefit us the most and how we can try and take advantage of it. So we'll go through all of that. I do want to, talk a little bit about the various sectors and industry groups and how they're performing relative to one another and relative to the S&P 500, because that goes a long way in determining how we want to put these portfolios together. And at the very end, I'll go over many of the, several, maybe a dozen or so of the really strong industry groups that have shown strength, not just I'm not talking about 1 week or even 3-4 weeks. I'm talking about groups that have shown consistently strong action over the course of, say, maybe the last year or even longer. So all of this will play a factor in how we select our stocks for the draft and going forward. So that event will be on Thursday. We'll get through all of that hopefully fairly quickly. That's usually a long webinar, but I'll do my best to try to keep it down and more palatable for most schedules. But right now, I'm going to go ahead and jump in and talk a little bit about the performance of each of our portfolios, and then just talk about some of the things that have impacted it. So first up, this is the chart that I include in the portfolio report, that weekly portfolio report that I do every, well, usually on the weekend. It can be anywhere from Friday to Sunday. But here you can see this is the model portfolio and how it's performed. So the very top here is the model portfolio itself, and underneath is the S&P 500. And I want to just point out a couple things long term, because I think sometimes this, you just go quarter to quarter, and we want our portfolios to outperform every quarter, and they just don't do it. And there's a number of reasons for it. But I want to break it down on this model portfolio chart, then we'll kind of go from there. We started the model portfolio back in 2018, and you can see we had quite a run from 2018 to the early part of 2021, and we still haven't gotten back up to that level yet, which on the one hand is pretty disappointing, but then on the other hand, when you realize what got us there in the first place, I think maybe it becomes a little bit easier to understand. So the model portfolio made a huge run during 2019, of course, pulled back with the pandemic, and then made another huge run into the early part of 2021. And you'll see that mostly with our portfolios. I mean, you're going to see that with the aggressive portfolio as well. And one chart I just want to point out to you that I think really impacts this is when you look at the small cap IWM Russell 2000. The IWM, of course, is the ETF that tracks the Russell 2000, and you compare it to the Spider, what you're going to find is that from the beginning of 2020 to the early part of 2021, we had massive outperformance by small caps. Everybody kind of forgets that now because we've gone through the last 3 years where it's been mostly those large cap names that have been carrying the market, especially the Magnificent Seven, because they're weighted so heavily in the S&P 500. But I just wanted to point out from 2020 to 2021, the IWM crushed the S&P 500. And that's kind of what I'm looking for, maybe not to this degree, but I'm looking for a lot of strength from small caps later this year. And you can see right now still has not really transpired. We haven't seen it yet. And we're already 4 months into the current year. But part of the issue, I believe, is the fact that Fed has moved the rate cuts back. And so I think some of the impacts from those rate cuts haven't been felt yet. I think, we started to see some outperformance in the fourth quarter of last year, the IWM. And then as soon as we got to the point where, hey, maybe we're going to push this back a little bit, then you can see the struggles kick back in again. I do believe, though, that by the end of this year, we're going to have a rate cut, at least one. I'll be shocked if we don't have any this year. I'm starting to see some signals now about the economy slowing. I don't know that the Fed is going to have to wait to see 2% target to begin lowering rates. I think if they start to see cracks in the foundation, the economic foundation, that in itself will bring inflation down. If you have, if your economy starts to weaken, the demand goes down, and it's the high demand which is what triggers inflation. So I believe we're going to see a rate cut later this year, either because the economy is slowing or because inflation is more in check, or maybe both. And when that occurs, I do think we're going to see a big push higher in small caps versus the S&P 500. So again, when we go back and we look at what happened and where we, got so much strength from our portfolios, it was because we were able to take some of these small caps and mid caps that had been performing extremely well and ride some of those stocks. And those are the ones that really gain quickly. So I've always viewed our model portfolio and our aggressive portfolio as very aggressive portfolios. If you're thinking about, okay, well, I want to manage an ETF portfolio and I've got X dollars and about 20% of it, I want to consider maybe aggressive ETFs. That's where I think the aggressive and the model portfolios would come in. And as long as we struggle with small caps and mid caps, it's going to be a little bit of a problem for the portfolios, because we can't be in just Apple and Microsoft. And I mean, I guess we could, but that's not the way these portfolios have been built. They've been built by looking at relative strength, spreading out that, spreading out the dollars among several growth stocks in various growth areas. And the market just hasn't been set up as well for that over the last 2 to 3 years. So again, I think that's pretty important to point out. This is the IWM versus the spider, but also we'll show you the MDY, which is the mid cap index. And look at, again, March 2020 to February or even early March 2021, massive outperformance by small caps and mid caps. Now, we did have a little bit of outperformance, well, pretty significant amount of outperformance in the second half of 22 by mid caps. But for the most part, since that top in March, you can see that it's been mostly lower in mid caps. So I want to explain this because, I get questions sometimes about the portfolios and, they haven't performed as well. Well, part of it is because the leadership has been so narrow over the past few years. Now we're starting to see that pick back up again a little bit with some of the some value names that have outperformed from period, during some short-term periods of time, maybe the last 2, 3, 4 months. We've seen a little bit more of that. But again, from a big picture standpoint, it's really been the lack of relative strength in small caps and mid caps that have dictated to some degree our performance. So I wanted to mention that because we have, tracked below the S&P 500, especially on the aggressive portfolio. And we'll look at that one in just a little bit. You can see the mid caps, the model portfolio has actually been strengthening again. And we've been trying to keep up, maybe not quite with the S&P 500, but we've been doing pretty well. And we're still up right now, or as of Friday's close, we were up 193%. Now this says, if you look at this, it says 293, but we started at 100. That was kind of our base level. So we gained 193 on that 100. So we're up 193.67%, while the S&P 500 is up 94%. So over time, this model portfolio has done extremely well. I'm sure there aren't too many portfolios or funds out there over the course of the last 5 to 5.5 years that have performed the way this model portfolio has. But again, going through when we started to see all this strength in the S&P 500 return in 2023 and even into the early part of 2024, a lot of it was based on the Magnificent Seven and a lot of the strength coming from those stocks that are so highly represented on the S&P 500. So without those stocks in your portfolio, it was almost impossible for any fund to beat the S&P 500 because, again, the strength was coming from a much narrower group. Now, I believe that we are starting to see a lot more strength in a lot more different areas, more value-oriented, defensive, to go along with some of the growth areas that are still doing okay. They've pulled back, but they're still fine, technically. So anyway, I think that is going to be part of what we see over the next year. I really believe small caps and mid caps are going to be leading this market. I think it's been pushed back, as I said earlier, but I really expect the leadership to come back into those areas, even if it's just for a year. I'm not saying that small caps are going to be, where you want to be for the next 20 years. I'm just talking about this. These groups have been really beaten down, and a lot of it has to do with the interest rates that have gone from, under 1% now to 4.5% on the 10-year Treasury yield. And the Fed funds, the short-term rates, that are charged to banks, the Fed funds rates jumped basically from 0 to 4 or to 5.5 or wherever we are right now. I think it's 5.25 to 5.5, whatever. But when that reverses, and that's been the big problem with small caps, is the interest rates. These big Magnificent Seven stocks, they don't need to borrow. They don't need to grow their business by borrowing from banks to leverage their growth. They've got all the cash. I mean, they're cash cows. It's the smaller and mid-sized companies that have been hurt the most by these rising rates. And the fact that these rates have gone up and we have an inverted yield curve, it's actually hurt the small and mid-sized banks more than it's hurt the big banks who use a lot of their trading. I mean, they make a lot of money from trading and other areas that most, smaller banks don't have the wherewithal, to get involved in all that. And I used to audit small community banks primarily. I was involved in a couple of other larger banks, but for the most part, I dealt with small community banks. So I'm very familiar with the small and mid cap type banks and some of the problems that they're going through right now. But in order to sustain those banks, they have to borrow from the Fed. Those borrowing costs have gone up. They really can't compete with some of the bigger banks in terms of some of the CD rates and so forth that are offered. And then, of course, the economy's been okay, but it hasn't exactly been scorching. And so, small banks have been at a disadvantage. But I think when the Fed funds rate starts to drop, I think that's when the playing field starts to level. And I think the smaller and mid-cap banks will perform better. I think be willing to lend more. And as a result, I think that will be the lifeblood that gets sent into the small and mid-sized cap or small and mid-cap stocks. So anyhow, it's a little bit complicated, but I don't know. On the other hand, maybe not so much. We need rates to come back down. We need to see that inverted yield curve flip for many of these smaller banks, mid-sized banks. But anyway, that's the performance. I think, again, overall, I think the model portfolio has done exceptionally well over 5.5 years, but we've had to deal with a challenging market the last couple years. And if you've noticed in the model portfolio, I've had more of those larger names in that portfolio just to try to keep up with the S&P 500. So I've been, that part of it, I think, has been much better. But we've still got a lot of work to do, and we really need to see some leadership from small and mid-sized cap or mid-caps in order to, I think, to perform better in these portfolios and start outperforming on a more consistent basis versus the S&P. Looking at the aggressive. So the aggressive, again, we went into 2021. You can see the huge move in the aggressive portfolio. The aggressive portfolio used to have a huge lead over the S&P 500, and it has shrunk because over the past 3 years, you can see this is where the S&P 500 was. Here's where we are now. And with the aggressive portfolio, for the most part, been going sideways, which means we've been underperforming the S&P 500. But the aggressive portfolio is exactly where we've seen many investments in our portfolios in those small to mid-size companies. And so that has clearly been a problem because, again, if you go back and we look at mid caps, I mean, look at where we were in 2021 and where we are now relative to the S&P 500. If you're putting mid caps into portfolios, you're at a major disadvantage unless you're getting the absolute best ones every quarter. It's really hard to outperform when you've got mid-cap stocks in your portfolio. And the same goes with the small caps. If you've got any of the small caps, I mean, this is what we've been dealing with for 3 years. Anytime we put a small cap or a mid-cap stock in our portfolio, it has created some potential issues. But we don't want to be overly concentrated in just one area. We'd like to split up between large cap, small cap, mid cap, different industry groups, different sectors, so that if one area of the market gets clobbered, we don't, get clobbered with it. So instead, what we've been doing is just kind of, like I said, in the aggressive portfolio, we've just been going sideways. We have some strength, then we give it back. Then we have some strength, we give it back. Have some strength, give it back. And there was one other factor this quarter why we underperformed. The model portfolio actually is almost even as of Friday, was almost even with the S&P 500, which actually was outperformance because if you recall, the last quarter when we started, after we had the draft, I think we did the draft on like February 17th or 18th, and we were getting out of our portfolio stocks on the 19th or the 18th, whatever that Friday was. But remember, we didn't go into our new portfolio until the end of the following week. And so we sat it out 1 week because the 19th to the 25th tends to be a week time of the month, of a calendar month for the S&P 500. But instead, what we saw was the S&P 500 go up 1.5% that week. So we sat out, and obviously we're underperforming the first week by 1.5%. So that didn't help us in the last quarter either. So little combination, but if we ignore underperforming by 1.5% in that first week, the model portfolio from February 25th on actually outperformed the S&P 500. And again, with mid caps and small caps lagging for the most part. So there are reasons, and the reason why we go through this and we talk about themes and we talk about why we're going into small caps or mid caps or why we're going to go into technology or discretionary, it's so at the end of the quarter, we can actually go back and say, okay, this is why we underperformed, or this is why we outperformed, because this is what we thought would happen, and it either did or it didn't. And if it doesn't, then obviously it's going to impact your performance. The last one I want to talk about real quick is just the income portfolio. This one always lags, and I want to explain why. First of all, when you're in a secular bull market, growth stocks are typically going to outperform value stocks. And when you're looking at income, an income portfolio, you're looking at dividend payers. And most of the stocks that are going to help us outperform the S&P 500 over time are not dividend payers. So you've got to go a lot more with defensive and more value-oriented stocks. You can throw some growth stocks in there, but just by the nature of the stocks that you're going to put in an income portfolio, those types of portfolios are generally going to underperform the S&P 500 during a secular bull market. I mean, it still went up. I mean, this is where we were in 2019. So we're up 37% over those, 4.5 years, or no, maybe almost 5 years. So we have gone higher, but it's just not going to be, it's not going to exceed the S&P 500. It's probably not even going to get close to it. Also, in this portfolio calculation, the income portfolio, we don't add in the dividends that were earned. This is simply the stock price. So if you throw in the dividends for the last 5 years, which wouldn't be a lot, but it probably would take us maybe up another 10 percentage points, maybe. I'm going to say perhaps 147 instead of 137. So then you're looking at 47%, maybe it's 50, I don't know. But that would be your total return, which would be probably close to 9% a year, which isn't too bad. But the S&P 500, being in a secular bull market, has done better than that. So when you get into an income portfolio in a secular bull market, you should not expect to outperform the S&P 500. So I just want to be clear with that. I think we have done a little bit better job with the income portfolio because, again, I started to put a little bit more of the growth names in there, as well as some of the high dividend payers that are more defensive. And so I think that the performance did pick up some. And you can see that since the end of October last year. But also the nature of the gains have helped us. You know, what areas have been leading and lagging. So anyway, I just wanted to explain those three. So again, IWM underperforming, mid caps, the MDY underperforming. That has not helped our performance here over the last 2 to 3 years. But I think that that is going to be the backbone of some pretty significant outperformance. At least that's what I'm hoping for as we go forward. And as these stocks do start to show more relative strength, I believe as we have these in our portfolios going forward, it may not be in this next quarter, but I think maybe the quarter after, we could really start to see some significant outperformance in that small cap area and mid cap. Anyway, so that's kind of the results slash, portfolio creation and allocation, if you will. So let's move on to some of the themes that we're still dealing with. Obviously, one big one is inflation. And we've seen some big moves to the upside when the inflation seems to be coming under control. And then we get these big drops in the market when it looks like inflation is rearing its ugly head or maybe rebounding again to the upside. What I can say is that if we shorten this and just look at the more recent action here, this is what I'm seeing. I am seeing that the monthly readings, the 1 month readings, have steadily been going lower and lower. Doesn't mean we don't have some gyrations and some crazy volatility back and forth, but since we topped, and this would have been back in 2021, since we topped, I believe these monthly readings have continued to drop lower and lower and lower. And with some of the signs I'm seeing as far as the the economy may be slowing a little bit. I mean, we had the initial jobless claims jump by a pretty wide margin, jump about 10% above expectations last week. Be interesting to see what happens this Thursday there. When we had the jobs report come out, came in much below expectations, but it was still positive. The consumer sentiment numbers that came out last week saw a big drop. So I think the economy isn't great and it's starting to wear a little bit. But the good news is if the economy does pull back, I think that is going to be seen by the Fed as something that will help drive inflation lower, which then gives them the ability to lower rates. And again, I believe it's coming sooner than most. I think we'll get at least one rate cut this year. I wouldn't be surprised to see 2 rate cuts this year, at least 2 rate cuts. But anyway, I'll just stick with that for right now. But anyway, the key here is that inflation's coming down. And one of the things I pointed out 3 or 4 years ago was that, and I pointed this out in 2021 when I said I thought the market would have a really good year. I said that once you peak in inflation, this is the history. Once you peak in inflation and start to roll over, the stock market does extremely well. And that, the 2021, I mean, when that started coming down, that's what led to that 115% advance in the S&P 500 over 22 months. Much of it was related to the fact that inflation was starting to drop. So I think we're still in this period where inflation continues to come down, which I think only sends the market higher. And with the economy potentially slowing a little bit even, that gives the Fed, I think, reason to start cutting rates. And when you cut rates and companies are beating expectations, the leading companies beating expectations, and you're cutting rates, that is a win-win for performance on stocks. So I'm still very bullish. Now, down here, you can see the annual rate of inflation measured at the consumer level, the core CPI. We had this double top back in 2022. That's when we had topped and we started to roll back over. And as you can see, actually from this top right here, it was just about the end of the cyclical bear market in 2022. And since this annual rate has been dropping, we know what's happened in the stock market. We've seen huge moves to the upside, but we haven't seen rates come back down yet. And I think that is what's hurting the small caps and the mid caps. Once the rates start to come back down, I believe that's when we're going to see some really big performance numbers from many of those, or from that area of the market. All right, so inflation still a big thing that we're dealing with. Next up, I wanted to show you the S&P 500 first. This is over the last 5 years, and it's on a daily chart. I don't care. All I'm looking at is which direction. Are we going up or are we going down during these various periods? So it doesn't matter if you can't see these individual candles very well. Again, when we're going up, what are some of these offensive or aggressive sectors doing? And what you will see is that for the most part, here's technology relative to the S&P 500. For the most part, we go up. When we go sideways, like we did in 2020 and 2021, technology was not leading here. It was kind of going along for the ride, but it was not leading. And yet the S&P 500 kept going higher. Why? because many of the smaller companies were performing well. Remember that IWM spider? Look at this. 2020 into early 2021. So when we come over here and we're looking in 2020 and into 2021, the large cap tech tech names really weren't doing that well. But that's when we saw a lot of the smaller companies doing much, much better. And so, technology held us back a little bit, but we had some other areas of the market, like the communication services, like the financials, like the industrials, that were all performing well. And that's what drove the stock market higher. It wasn't technology and it wasn't consumer discretionary. It was money rotating into these other areas. And that's why I don't believe the market's going to sell off, even though technology and consumer discretionary are struggling, because I believe the market is looking ahead, seeing rate cuts coming, and we're starting to see some of that money moving into value-oriented areas. And I think you're going to see a lot more money moving into small caps and mid caps. And that, I believe, is what's going to drive the market to the upside minimally. I said back at the beginning of the year, I don't think the S&P 500 is going to have a great year. I thought the IWM was going to have a great year. And like I said, it's kind of a can that's been kicked down the road a little bit. I think it's going to start. I'm not sure exactly when. Tell me when the Fed is going to acknowledge a slowing economy and falling inflation rates. And then I'll tell you when I think small caps and mid caps are going to outperform, because that's what we're going to need. So there are some folks, and I've been getting some questions coming in from members asking about this. Technology is going down and discretionary is going down. This is exactly what happened at the end of 2021. Why isn't the S&P going to have another bear market? Well, a couple of things. Number one, the actual price chart, especially on technology, doesn't look that bad. The relative price action doesn't look great, but again, it's money rotating. The other thing is that these relative strength lines for our various sectors, these are secondary indicators. When we talked about at the beginning of 2022, the possibility of, or maybe even the probability of a cyclical bear market developing, the ratio analysis I did was just one small piece of everything I saw. It's a secondary indicator. It's one piece. But as soon as we start to see it, the ratios roll over, there's a lot of members who are, asking questions, wanting to treat this as though it's a primary indicator. It's not a primary indicator. This is a secondary indicator. If you recall, back at the end of 2021, we had massive negative divergences on the weekly charts. We had sentiment that was off the charts bullish, meaning anybody who wanted to buy had pretty much bought. You remember all those meme stocks and the Reddit folks, Wall Street bets? I mean, that's what drove the market up 115% in 22 months. That's what we had going into 2022. We had the stock market the most complacent that I've ever seen it. And I even pointed that out at the beginning of 2022 in Market Vision 2022. And I said, the biggest problem with the stock market wasn't inflation. It wasn't the likelihood of higher rates. It wasn't the negative divergences. It wasn't the rotation. It was sentiment. I mean, you go back and listen. I mean, I haven't listened to that recording in years, but I can tell you it was sentiment. And I remember making that exact comment, that that's the one thing that was driving home that this market had limited upside. We're now exactly opposite of where we were then on sentiment. So anyone who's worried about money rotating into defense lately, and I'm going to show you another chart here in just a minute, which I think will alleviate a lot of your concerns there. But keep in mind, that's a secondary indicator and it's one piece. Don't try to make it a primary indicator. Anyway, when you look at this, I'm still looking at right now. I mean, industrials are performing well. They've been performing well. They go through their ups and downs, but they've been trending higher. I think financials, which have been strong now for about the last year on a relative basis, I think they still look poised to go higher to me. I think financials are going to continue to do well, whether or not they lead, because they don't always lead in a bull market. A lot of times they just go along for the ride, but we might continue to see a little bit of leadership out of the financials. Look at communication services. Internet stocks have been really strong. Communication services, straight up. These are three of the aggressive groups. Technology, all the way until the end of January, was incredibly strong. It doesn't go up relative to the S&P all the time. We do have sideways action here. If we went all the way back, I think it was like in 2013 that, let's change this to weekly. And let's go back, I don't know, we'll go back like 12 years during the secular bull market. But look in 2013, look at the S&P go up and look at XLK relative to the S&P. It took time off. Now, in that case, we saw discretionary doing well. We saw communication services, financials, and industrials all doing well. So that more than made up for technology pulling back. But when I look at technology pulling back here, first of all, it's only been a couple of months. I see other areas, other offensive or aggressive groups continuing to perform well. And then, there have been periods where energy and materials have led. I want to show you now the defensive groups. And take a look during this renewed secular bull market advance that we saw coming out of the cyclical bear market of 2022. This move up in the S&P 500, tell me how good these defensive groups look. When we, use perspective, when we back off, because right now we're looking at, oh, well, staples have been hot for 3 weeks and, utilities have been hot for a few months. But look at what has happened over the course of the last, well, probably since the beginning of 2023. So almost 18 months. Look at the defensive groups. There's healthcare relative to the S&P 500. Does that look like money is pouring into healthcare? I don't see it. How about here? Here's your staples. I've had a number of questions coming in recently about staples performing so much better than discretionary. Look at staples relative to the S&P 500. I mean, here was the pop we had in April, but otherwise, I just see this thing spiraling lower and lower. Real estate, lower and lower. We're not getting any pops there. We had one at the end of last year, but then it went right back to new relative lows. And utilities. Okay, utilities have been up for a few months. They did that last October through December. The overall trend here is clearly lower, down, to the downside. So, yeah, this March-April period right here, you can see March and April went up here. I don't know what it did in the prior years. Well, here's March-April went up actually through May. It kept going up a little bit even into September. Let's see where else. March-April right here, we went up a little bit. March and April, we shot up, then we came back down in April. But my point is, and I pointed this out before, March tends to be a really strong month for utilities. And March kind of got things started again this year, and then we really took off in April. But look at the long-term picture. We're going lower. Now, if the S&P 500 3 months from now is breaking out, and we've seen a complete change in maybe sentiment, and we see all of these defensive groups, really moving higher. Look at what happened in 2022 when the cyclical bear market really started to grab hold. When we went down, you can see these defensive groups making big moves to the upside, big moves. Real estate was a little bit later, but look at, utilities then. Big move through the entire cyclical bear market. Here, most of these groups, I'm just not seeing it. I'm not seeing that relative strength lasting very long at all. A little bit here in utilities. We had a couple of weeks in staples, but I'm just not seeing it. Maybe everyone looks at it a little differently than me, but I still think Aggressive groups remain in control in the big picture. The defensive groups are lagging. And then, we've got energy, which has gone through. I mean, energy carried us for a little while. That started to roll back over. Materials had a really strong February through beginning, maybe even middle of April, and that has started to roll over. So I'm not seeing the problems or the issues that maybe some others are seeing. I think stock market goes higher and we want to take advantage of that. Now, on this chart, you can see the S&P 500 moving up, and then during the correction moved down. Then we kind of came back up again, and then we saw the weakness in April before turning back to the upside. That's the S&P. Now, down below here, we have the IWF, IWD. Now, I just pointed out recently that we tend to see the strongest period of relative strength, growth versus value, from May through August. And you can see right here was May. We're already up, even though we pulled back over the last week or so. We're already up in the month of May, growth versus value. So I think we're already beginning to see it. Now, obviously, if we turn back up and we take out these two highs on a relative basis, that'll be showing us even more. But if we do that in connection with another breakout in the S&P 500 to all-time highs, I mean, this again would just be another very, very bullish development. All right, the last thing I want to go over is I want to talk about some of these industry groups that I think are worth, checking out. So let me talk about some of these. Obviously, semiconductors. I mean, look at semiconductors relative to the S&P 500. Now, I know, the tendency is, well, this can't go on forever. It's just going straight to the sky. It's parabolic. Well, part of the reason why it's done so well is that we have seen growth in this area. Earnings per share on some of these companies have been mind-boggling. I mean, what we've seen, even Texas Instruments in this last quarter, which had been a laggard for a long time, exploded in terms of its earnings. At least for Texas Instruments, it exploded. And now we're talking about lower interest rates down the road, which only makes growth prospects even stronger. You value future earnings growth even more in a lower interest rate environment. So I don't think this is going to let up anytime soon. I think semiconductors are going to continue to perform well. And I think any selling, you're going to see buyers stepping back into the group, just like we saw with the selling in April. We quickly broke that downtrend line and, now trying to move our way back up again. Next up, I wanted to show you marine transportation. Now, this is a very odd group. And let me see if here it is. Because this has been, one of the better areas now over the last few years. But look at the long-term track record. And I could probably even go back further, go back 20 years. I mean, this thing does nothing but go down over time. So when I see these pops, I mean, here was a pop, here was a pop over here, got a couple of these pops. Well, this is a pop. When I get these, it makes me really nervous, especially when we had a triple bottom breakdown and we're almost back up to where that triple bottom breakdown occurred. So while I'm looking at this and saying, yes, this is one of the strongest areas, I also have to question whether it's going to last. And if we happen to get into a marine transportation stock in our portfolios, when this thing starts to turn down, it's going to pull our portfolio down significantly. So I tend to stay away from groups that have long-term relative downtrends. And that's what I still believe we have here with this marine transportation group. The next group, Nonferrous Metals, which essentially is Freeport-McMoRan. When you see whatever that stock does is generally what we're seeing in this group. Now, we had the huge move up 2020 to 2021. We've seen sideways consolidation. We kind of remain in this sideways area, but recently we've seen the strength pick up here. And as a result, we've seen that relative PPO move significantly higher. Let's see, next group, paper. And again, look at the volatility here. So with downtrends or volatility like we saw in marine transportation, even in non-ferrous metals and in paper, I mean, we might have a dividend payer in here that might get included into the income portfolio. But I mean, look at the moves up and down. I mean, I don't see, just because we've been strong for the last 2 or 3 months doesn't make me feel great about what's going to happen over the next 2 or 3 months, because the history is this thing just stops on a dime and reverses. So again, I'm looking at strength. I'm trying to find leading stocks and leading industry groups, but is this the kind of leading industry group I want to jump into? Probably not. Next up, heavy construction. So this is back in the industrial area, and that's right here. Now this one's been moving up now for quite a while, since back in 2020. And there are stocks within this group that have done well over time, done much better than what the overall group has done, because you can see it downtrended for many years. But this is in a pretty nice steady uptrend. And like I said, there are definitely some individual companies within this group that have nice long-term track records. So if they're leading right now and the group is leading, there's a chance we're going to see a heavy construction company or two that might make it into the portfolio. Next up is aluminum. So back to the materials. And aluminum, you can see going through these various periods, big up, big down, big up, big down, big up, big down, big up, down, and now we're up. The question is, how long is that going to last? Hopefully you can see as we go through some of these material groups that during a period when the dollar is strong, and the dollar's been uptrending. I'm not talking about the last month or two or whatever. I'm talking about looking at a 20-year chart, and you'll see that the dollar downtrended from the beginning of the century to about 2011 or 2012, or actually probably to about 2009, and then went sideways to about 2011 or 12, and then the dollar started back to the upside. We've been uptrending. So if you're looking back at 2011 and trying to see, well, aluminum's been underperforming more often than it's been outperforming, a lot of it has to do with the rising dollar environment. And I'm still a believer that the dollar is in an uptrend. So again, that puts a lot of added pressure on picking a material stock. If I did it, I'd probably do it with less than a 10% position. But I'll look at these, but chances are I'm going to say we probably will not have any of these stocks in our portfolio. Next group is internet. And this is a group I can get behind. I really like Google. Google's been performing well. Gapped down earlier today and came roaring back again, which it's been doing recently. I think the stock wants to go higher, but internet stocks in general. Now you can kind of see the difference between in a secular bull market, what some of these growth areas do versus what some of the more value-oriented areas do. Internet, we had a horrible period for about a year and a half here, but we've come back. And again, I'm not going to bet against what has been a long-term uptrend in internet stocks. So this is a group that I'm going to like, and you'll probably see at least one, maybe a couple internet stocks in our portfolio this upcoming quarter. All right, next up, Broadline Retail. So we've kind of gotten our legs under us with Amazon, and that's certainly helping this group as a whole. So let me see where that is. And this is kind of like the internet group. Big move up, went here for about 2 years to the downside, and now it's a steady move to the upside. Knowing what we know, these uptrends can last for a long time. So there's a chance you're going to see Amazon or another broadline retailer in our portfolios. Next up, we're going to go to technology. This is really outside of semiconductors, the only group that looks really strong right now. We've moved to about a 4-year relative high, dating back to the early part of 2000 to where we are now. The group overall during the secular bull market just kind of goes along for the ride. But if I can find a stock in this space that is really showing some nice leadership relative to its peers, we might see one of these stocks in the portfolio coming up. Home builders, talking about rates maybe coming back down, although, the home builders, they're going to look more toward the 10-year treasury yield than to the Fed funds rate. 10-year treasury yield is more in line with what you're going to see with mortgage rates. But I think the 10-year treasury yield will come down. I don't think it's going to come down anywhere near where it was. If you're looking to get a 2.5 or 3% mortgage, I don't think you're going to see that probably for another generation or two. But I could see the 10-year moving down back below 4% into the threes. That would be a nice cut in some of the what we're currently seeing in as far as the yields go. But let me pull up the home builders here. So home builders, again, from left to right during the secular bull market's done pretty well. Really been on fire here over the last couple of years. And some of this is when rates have been going up. So this is kind of a confusing chart, because if I looked at this and you told me rates were going up and yet we kept seeing home construction moving higher, I would argue that the economy has to be strong. And yet we're seeing some cracks in the foundation on the economy. So does that mean that this group is going to start to underperform? Or is this sending us a message that the economy down the road is likely to be better than we think? I don't know. Your guess is as good as mine. But when I look for leading stocks and leading industry groups, it's hard to ignore what's been going on in the home builders. So this one might be part of what we see in the portfolios as well. Next up, let's go back into the industrials. And here we're talking about the diversified industrials. And as you can see, this was a group that really was beaten up badly from 2016 all the way through 2022. We're getting a move back to the upside, but we're just now getting to key relative resistance. This would be a gamble to take an diversified industrial stock into the portfolio, because again, these moves to the upside have been somewhat limited. I'm going to go back a little further. Let's go back 20 years and just see. I mean, it's been going down really since almost the beginning of the century. So can we trust a move that's now a year and a half old to the upside? I would say probably not. So even though, and when I ranked these, by the way, what I was looking at was weekly PPOs, because that's telling us that the moving averages, that you're starting to pull away from these moving averages, and that the 20-week is now above the 50-week in most cases. And so, this is just giving us an idea of where the momentum is currently. Relative momentum, I should say. 3 more charts, then we're going to wrap this. Actually, 2 more charts, then we're going to wrap this up. Next is going to stick with industrials again and look at the building materials and fixtures group. And this one has been an uptrending group for a long time. Seems to do very well during the secular bull market and just made a new high, new all-time high. So I like the group. You'll probably see a stock or two out of this group in our portfolios. And then the last one I'm going to give you is number 13 in terms of highest PPOs. And this is the banks. Now, question is, what do you want to do with the banks? They don't look very good during secular bull market, but they've had to deal with a lot. I honestly think now with the rates moving back to maybe more normal rates in terms of a 10-year treasury yield, and with the inverted yield curve really set to flip later this year or maybe into early 2025, this is definitely an environment where banks should do well. So I don't know that this is a group that is going to fly in terms of relative strength, but I think it's a solid group that maybe just kind of goes along for the ride, maybe sees a little bit of outperformance over the next few months. And so I would not be, even though this has been a downtrending area of the market, I would not be afraid to include banks, especially into the income portfolio, because there are some strong banks still there: Citigroup, Wells Fargo, JP Morgan. I mean, all of those, and they pay nice dividends. So I'd say your chances are you're going to see one bank stock in the income portfolio. Doubtful that I would ever put these in the model. Or, I mean, if I was expecting more outperformance, you might see one of the big banks in the model portfolio, but doubtful you'd see it in the aggressive. All right. And that's it. So that's what I have. That's what I'm thinking going into this week. Again, I think in order for us to really begin to significantly outperform the S&P 500, we're probably going to need to see better performance in the small caps and mid caps. Otherwise, if they don't show strength, relative strength over the next 3 months, any stock in those two asset classes are just up against it. You're facing headwinds going in. But I do believe that they're going to strengthen. I think they could start to strengthen more considerably in this next quarter. I mean, could be as soon as Wednesday, depending on how the CPI report comes in. If that number comes in, we're expecting 0.3 at both the headline and the core level. If that number were to come in at 0.2 or 0.1, up against what we had last year, which I think was like 0.45 or 0.47, that would be a substantial move down in the annual rate that could take us back to like 350 and could quickly begin to flip some of the narrative that we're hearing from the Fed. So, we don't do the draft until after Wednesday's CPI report, so that helps. But if that CPI comes in lighter than expected and we get a big push to the upside, we see growth returning, and small caps, and even more so small caps and mid caps, that to me would be a great sign for the group going forward. But we'll have to see what happens on Wednesday. Anyhow, that's all I have for tonight, John. So I went a little bit over the 45 minutes, but I'll be happy to answer any questions.
Hey, listen, I think people just listened and took notes. Got a blank slate here on the questions.
Awesome. I guess I answered everyone.
Wrap it up.
All right, let's wrap it up. Appreciate everybody coming in, and we'll see you on Thursday for the actual draft. And of course, in the middle of all this, we'll get some key economic reports, a couple more earnings reports, and we'll go from there. Have a great
Max
evening,
Payne
everybody.
tomorrow night.
Yes, Max Payne tomorrow night. Don't forget that for sure. And also, we got our spring special starting soon. So just letting you know, get ready for that. Have a great evening, everybody. Happy trading.